Okay, so we've just pushed the first quarter behind us, and what did we experience in that time? Well, so far this year, the worst start to the stock market year in history to the end of January, followed by the sharpest rally in 90 years. Is this the new norm? Well, more on this, we're joined by Jonathan Davis, Managing Director at Jonathan Davis Wealth Management. Jonathan, thank you very much indeed for joining us. But what does this volatility mean? What does it point to? And what is it symptomatic of?
Well, it points to a huge tussle between the bulls and the bears, this level of volatility. It is literally unprecedented. And I think your listeners need to get that what's the old adage? Markets go up in an elevator and go down in a lift. And the point I'm making is that the sharpest falls in stocks come in bull markets, but the sharpest rises come in bear markets. And as you just said, we've had the sharpest rise in the stock market in 90 years. Then when you look at the economics, we've just had the Atlanta Fed saying that annualized GDP for the United States at the end of Q1 is merely 0.5%. That is tantamount to a rounding error with regards to recession. The US is on the precipice of recession.
But JP Morgan last Thursday, they were talking about, one of the key findings from their recent global fixed income, currency and commodities investment quarterly review in the short term said that accommodative monetary policy provides market stability, but in the long term, a recession is coming. So what are you pitching towards? In the long term, a recession coming, or is it imminent?
The West is slowing down already. If you look at the UK, for example, in 2014 we had 3% growth. Last year we had 2% growth. And this year the numbers are running at sub 1.5%. So we are already slowing down. They're obviously slowing down in the US. The Eurozone has a bit more growth, but I do believe that that's transitory. As far as I'm concerned, 2015 to 2018 is broadly similar to 2000 to 2003, the busting of the dot-com boom. It seems likely to me that the slowdown will continue. It seems likely to me that the major developed stock markets peaked last year, about a year ago, and although if you look at the US S&P 500, it's literally within a hair's breadth of the highs, 3 or 4%, but that's after, as we say, the sharpest rally in 90 years. It's in a downtrend. Small caps are in a downtrend. So I see the economy slowing down, and I see the stock markets in a downtrend, and the trend is your friend until it is no longer.
So Jonathan, I guess one difference with 2000 to 2003 today is that back then you didn't have sort of what I would call a dynamic or at least recovering emerging market sector. And when we take a look at asset classes that have underperformed over the last few years, it would include emerging markets and related. They seem to be doing a little bit better over recent months. And obviously there are some structural positives and rationales for that in terms of an expanding middle class population, urbanisation, and all these other big themes that we've heard about. How does that fit into your view of the next few years?
We've had an expanding middle class and the structural improvements that you mentioned for years, and yet emerging shares have been about the worst performers in the investment world for the last several years. Now, I would say to you that emerging markets have been rallying for the last few months for one sole reason, and that's because the price of oil has been rallying, and the oil producers makes up a very large proportion of emerging markets. I think we have to look at the US dollar to determine what's going to happen with oil, commodities, and emerging markets. The US dollar, as everyone knows, had its sharpest rise in decades, 25% up from 2014 to 2015, and it has been in downtrend since March of 2015, over a year. And indeed, just as we speak, the dollar index, that's against a basket of currencies, the euro, sterling, Canadian dollar, etc., it hit the lowest point in a year and a half as we speak, overnight. And as the dollar continues to fall, this is supportive of oil, commodities, and indeed emerging markets. However, there is nothing to say that the fall in the dollar is sustainable. On the contrary, I would say to you that it's likely to be closer to an intermediate bottom than a top. In other words, the dollar bull market will reassert itself, I would suggest probably by the end of the summer. And if it does so, then watch those commodities, watch those emerging markets collapse again. And if oil goes down, you can also expect the S&P go down, because again, the S&P has been rising because the oil has been rising. So no, I am not confident of stocks at all. The only commodity that I think might be a place to hold your money is gold and the various gold markets, because it could be the commodity that has actually bottomed. We'll have to see a higher low price, however. Gold got down to about $10.50 an ounce. It shot up to $1,300. Miners have doubled in price in the last 3 or 4 months, doubled in price. But if gold pulls back and then we see a higher low, then I think we're likely to see a multi-year rally in gold. And the other positive, I would say, is going to be government bonds in quality countries, such as the US in particular. You're looking at, on 30-year treasuries, you're looking at 2.5% to 3% yield, and you could be looking at capital growth over the next couple of years as well.
Thank you. Jonathan Davis, Managing Director at Jonathan Davis Wealth Management, thank you very much indeed for joining us this morning.